In my opinion, I think that to answer your question, I think the miners are just getting started. Especially, Gary, the fact that for the last 6 months, really, when the gold price consolidated between 3,200 to 3,400 bucks, and silver, the silver price has been consolidating for the last 3 months, just below 40 bucks. Gold and silver miners just really, began to move.
Welcome back to Metals and Miners. I'm your host, Gary Bohm, and today we're diving into the dynamic world of precious metals, the miners, and global markets from a very unique perspective with our friend, Eric Yeung. Eric is a Hong Kong-based entrepreneur and a respected precious metals analyst and investment expert with a sharp focus on the geopolitical and economic forces that are shaping commodity markets. Eric brings a wealth of expertise and fresh insights from his vantage point in one of Asia's financial powerhouses. Eric, it's an honor to have you back on Metals and Miners. Welcome to the show.
Thank you, Gary. It's a pleasure to be back again.
All right, Eric, you've been tracking and sharing your insights on the precious metals and miner space for years now on X/Twitter. You often boldly make calls, and then while waiting for the reality of that call to play out, there are many who ridicule your call, or they don't see it the same, or they're getting into the investment, but then things get excited and they exit too early. Many different scenarios taking place, but you've continued unfazed, trying to educate and help the investor community as it pertains to precious metals and the related equities. What do you hope for those tuning into our conversation today will walk away with after listening to our discussion?
So my hope is that people who listen to me today get their act together and start buying physical gold and silver. I know a lot of people come to me and say that, Eric, um, the physical gold and silver prices are pretty high compared to last year and the year before that. But I would say, in the big scheme of things, we are just getting started, Gary. I just popped an AI image on your screen. Eric Yeung is right about gold and silver. I made this AI image 2 years ago.
That's fun.
So, and I shared it. And back then, I think gold just broke out of $2,000, and silver was still lingering below 30. So see how far we've come. Like since this picture was shared on my X account.
Yeah.
And I say the same thing to people, right? If they do not own any physical gold and silver, it is not too late to start right now.
Okay.
So that's what I want people to take away with.
Wonderful. When you look at a gold to S&P 500 ratio chart, you see an 11-year base that gold is looking to break out of to the upside versus the S&P. The ratio just bounced higher off of a major support area and an upward sloping 200-day moving average. It's a really positive signpost for gold. Professional investors and the general retail investing communities, they're significantly underexposed to gold and gold stocks versus tech, versus the S&P and other sectors. That's been slowly changing, but do you expect that to accelerate when gold versus the S&P 500 breaks out from this 11-year long base?
So I just want to share the chart that Jordan from the Daily Gold recently shared with us. And it's exactly what you just talked about, Gary, which is the gold versus S&P chart. As you can see, because of the recent S&P, basically US general equities, US tech stocks, this FOMO, this surge, Gold is now, even though gold had been going up in the same period, we are now we're still on an uptrend, but it's below the the 20-year average. Okay. So I do see that I agree with Jordan, and I agree with you that we are reverting first to the historical 20-year average, and then we probably going to revert back at least to the point of 2013. And I expect, um, there's a possibility that we actually go beyond that. And why do I say that, Gary? Let me share another picture with your audience. This is something I posted on my X account on September 2nd. It's a snapshot of the period between 1973 to 1974. On the left side, you have the Nifty 50 stocks in the 1970s, between 1973 to December 1974. So the Nifty 50 stocks in the 1970s are basically the equivalent of the Magnificent Seven that we have today, like the Google, the Amazon, Netflix, Nvidia, etc. And the Nifty 50 peaked in 1973, and then slowly you can see that it grinded down, it rebounded, and then it grinded again, it rebounded, and it finally had its deepest dip in that period between April and December of 1974. Now, if you look at the right hand side, the chart on the right hand side, that's a gold chart for the 1970s. And within the same period, between 1973 to December 1974, which I bracketed in red, you can see that the gold price actually went up. Okay.
Yeah.
However, one observation you have to make is that every single time the Nifty 50 dipped, gold price also corrected a little bit. But then every single time when the Nifty 50 rebounded to a lower high, the gold price made a higher high. Okay, that's the difference. So this is something actually that Michael Oliver and I agree on. We have been, me and his son actually, Brett, we talked about this for the last 3-4 years, like least trust.
So
And
you're expecting as the S&P might continue to rise, but gold's going to rise further. But that relationship between gold and the S&P, gold is going to outstrip the S&P and begin its ascent back up that right side of the chart, the way it looked on the left side of the chart.
no, I'm expecting, let's say, the S&P grind sideways, and let's say it grind sideways and drop a bit, like the way you see with the Nifty 50
Okay.
between 1973 to 1974. I expect if that happens, gold, regardless of the corrections that the S&P experiences, gold is still going to go up.
Okay.
So I see a
Understood.
disconnection basically. Okay, as
Okay.
long
Yeah.
the underlying factor that would enable this would be the overall liquidity. So as long as global liquidity is still up, I see this happening, even
And liquidity
if
is up.
stocks
Yeah.
and liquidity is up. And actually, I have another chart that I can share with the audience on the liquidity. If you just hold on a second. Here. Okay. Okay, so M2 money supply for US, China, European Union, and Japan. Isn't
Yeah.
that scary? Look
Yeah.
at that. That's pretty scary stuff, right? So I mean, there's no, I promise you, Gary, I'm not going to get into what some of the other people say, right? So I'm just going to stick to what I have to say. I just think global liquidity right now and possibly within the next 6 to 12 months is going to remain high.
Yeah,
Let's put it that way. And I think the charts speak for themselves.
I do too. Okay, so Eric,
That's it.
if gold prices stay at this 3,600 level or higher, they keep rising, and energy stays leveled in the range it's been in for the last several years, say 60 to 75 bucks, then inflation is muted, revenue is up, so therefore earnings and forward earnings remain robust. That's the environment that professional investors like to see and jump into. That's also the environment that the media likes to get really excited about to share those types of stories. Because of the small size of our sector and each individual equity, and because early investors, they're getting bucked off the bull and they're nervous about losing gains that they've already gotten, there's going to be volatility. But if you can have patience and stomach the wild volatility and recognize the setup that is now here for the miners being robust earnings, then the rise in the miners can be something to behold as larger investors start to get in, the media spreads the word, and then the large pool of retail investors come in behind them. Right now, they have their eye on something else, the tech sector. They're still in other places, but eventually, that large pool of retail investors, they're going to start changing their gaze over to our little tiny sector. So essentially, what I'm saying is watch the gold price, watch the energy price, watch earnings. Your thoughts?
Well, Gary, I'm going to share another chart with the audience. You see it here?
I
It's the
do.
mining industry as a percentage of global equities. So at the peak in the 1970s, it's around 8 to 11%. Where are we now? We're at, let's just say we bounced back from 1. We're probably at 1.5, but that's way, way below the historical average of around 6%, which means that let's say we revert to mean in the next 12 months, we get back to 6%. That's what? That's like a 6x from where we are right now. Or even let's say we're at 1.5 right now. That's like a 4.5 to 5x from where we are right now. Isn't that amazing? So that's the number one chart I want to show you, your audience, right? And then I have another one that is also very encouraging for the mining investors. And this is from Garrett Gogan, a very, very good gold mining analyst, gold and silver mining analyst on X. And he shared a chart here that shows the NAV discount versus the share price of miners, of gold miners. Look at how crazy the delta is, Gary. How
It's
much of a
amazing.
discount NAV, like the blue line is the share price. Okay, so the more discount, like the share price is a hell of a lot more discounted than the NAV, right? I mean, like again, let the numbers speak for themselves. So basically, in my opinion, I think that to answer your question, I think the miners are just getting started, especially Gary, the fact that for the last 6 months, really, when the gold price consolidated between 3,200 to 3,400 bucks, and silver, the silver price has been consolidating for the last 3 months, just below 40 bucks. Gold and silver miners just really, began to move during this period. And then the host actually asked me why. Like why is it that for the longest time, gold and silver miners were lagging the gold and silver price, but all of a sudden, when the gold and silver prices were consolidating, the miners shot up in value. And I'll explain to your audience here. It's simple. It's because miners are businesses. They don't like spikes in prices of their product. But what they do like is the stable high price of the product that they sell. So the longer that the gold price is above $3,000, and the longer that the silver price is above $35, the more likely are the senior, mid-tier, and junior producers of gold and silver able to take advantage of these high prices. So basically, to simplify it, the higher the 150-day moving average of gold and silver prices, the better chance that the gold miner price gets back to their fair value, okay, which we're not at yet. So in my opinion, we're just getting started.
Wonderful. All right. So I know you've seen this. Tether, the stablecoin group, has reportedly held talks to invest several $100 million into the gold miners. Saudi Arabia invested more than $1 billion into a silver ETF, likely to not create a bubble in the small sector. While not directly mining, Poland's central bank is raising their target for reserves from 20% to 30%. Eric, things seem to be speeding up in the precious metals and mining sectors. What is your perspective?
So I'm just going to share another wonderful screenshot with the audience. This one is big. It says India, the Reserve Bank of India, which is India's central bank, has announced over the weekend that it is cutting. This is not my words, okay? It's the words of the Reserve Bank of India. They're cutting the treasury bill share in their forex, holdings, but at the same time, they are opting for physical gold. So combine this with everything you just said, I think it's positive for gold. And actually, this article, if you actually read the details of it, it says that in the Reserve Bank of India is also buying silver as a strategic metal. So this benefits both gold and silver. But of course, the other two parties that you mentioned, they are buying physical gold.
So, Eric,
Yes.
a few years ago, there was not a lot of activity surrounding gold like there is today. It seems like there's a lot more action happening around
Yes.
gold, silver, and the miners today than, say, 2 years ago. Why are things heating up the way they are?
I think there's a structural change to the status of the US Treasury bonds in the eyes of potentially neutral or non-US friendly sovereign nations, especially after the US and the European Union froze Russian assets after the Russian special military operations in Ukraine. And recently, I don't know if you know, Gary, the European Union came out again and said that they are about to push the button to confiscate the Russian assets
I
that they
saw that.
froze. So basically, combine all that plus the fact that Donald Trump is potentially going to be slapping 100% tariffs on India, and today Donald Trump just announced that he's blocking U.S. tech companies from using Indian tech companies, outsourcing stuff to India. All this is really pushing India to the arms of China and Russia, which we saw at the BRICS summit recently. And therefore, I think there's like I said just now, there is a structural change to the status of U.S. Treasury bonds, where all these global South countries are opting to store their trade surpluses into physical gold rather than recycling it into U.S. Treasuries.
Yeah, I would agree. And we're going to get into the Fed and treasuries here in a moment, but I wanted to stay on the miners here for a moment. My miners only portfolio, which includes gold, silver, uranium, energy, and some agricultural miners, it bottomed on April 7th over fears of a tariff-induced recession. Since then, the portfolio has risen 76%. The last few days, it's softened, other than this morning, but I'm sure you've also experienced that in your portfolio over the previous couple of days. Do you think there was profit taking, or do you think some early investors got bucked off this bull? How do you view what is happening with the miners over the last few days relative to the larger bull cycle?
So I'm going to share another chart with the audience. This one is also wonderful. It's from the around 2005, 2007 to 2013. So it outlined the entire physical gold bull market from 2009 to 2011, the middle of 2011, almost 2012, when it peaked and started the long correction. So as you can see, you know, the physical gold really grinded up. It was like you know, 3 steps forward, 1 step back, every step along the way. And then once in a while, there's a big green candle, and then you have the big red candle right after that. But that's usually when physical gold price already grinded up for a period of time, right? So if if you look at that chart, if it grinded up for, let's say, 3 or 4 months, and then you have that intermediate blow off. Okay, that's where my black arrow is pointing at. Then you have that profit taking or correction there, right? So the difference this time, the reason why I mentioned, this period of time in between 2007 to 2012 is because this time around, the physical gold and silver prices consolidated for already, in the case of gold, 6 months, and in the case of silver, 3 months. So we weren't grinding up, like, it went sideways for that period of time. Which means, in my humble opinion, the miners are just getting started to move up to the next phase, instead of, like you said, potential huge pullback in the immediate future.
So basically, if I'm hearing you correctly, don't be a smarty pants and sell too early.
Correct. It's as simple as that. If you look at the charts, that's what it says. Don't sell at a intermediate correction, if we can call it that, and then you're just waiting until the liquidity implosion actually happens, let's say 16 months down the road, and you can't help yourself, you go all in, and next thing you know, everything collapses. You don't want that.
I think there's a lot of people who
Yeah.
are, who could be getting bucked off the bull that, bought earlier to get positioned, then they experienced losses, some sizable losses, 20, 30, 40, 50, maybe even as much as 70%. And then now that they have recouped that money and even gained, they're worried at the first sign of anything slowing down that they may lose that momentum and may go back into the negative. And I think that's why some of them are selling. They're like, okay, I got my capital back. I've got a little profit. I'm out. And instead, what they're missing is the reason why they got in to begin with, and that is a historical bull run opportunity.
I agree with that, Gary. That's what this chart actually shows.
Exactly.
Yep.
Okay. So there's an upward channel that silver prices have been in for about 3 years. Silver prices are now testing that upper resistance of that upward channel. In fact, silver prices have poked their head outside the upper range. Because of this, the question is it now time to open a short on silver and expect it to come back inside that upward channel? Or is silver breaking out and heading much higher? What are your thoughts on that?
I think silver is an exaggerated version of gold in terms of its price action. So given that, like I showed you earlier, the M2 money supply is still up and up, and the fact that the global south is only accelerating, is decoupling with the West, I simply, I think even if the price of silver corrects, it's only going to be a short-term phenomenon, which means that it might, have a flash crash to the lower bound of the upward trend that you're talking about, but it will go right back up very quickly. So personally, I'm not doing anything. I'm not doing any trading. I'm just buying, what I think is undervalued gold and silver miners, and I'm just sitting on them.
And a flash crash would only
So
occur, in your opinion, if we had a major recession or a major global event, or an economic crash like of '08, correct?
correct. Yes.
Okay. Yeah. All right. So let's go over to the Fed there. The Fed, Eric, is getting ready to begin a campaign to lower interest rates and likely inject trillions of dollars into the financial system as unemployment is now softening fairly quickly, all while inflation has been elevated over 2% for the last 54 months. And also, literally about every asset class is at or near all-time highs, except for silver. What do you expect the impact of the Fed's actions to be on the metals and miners?
I think I think the Fed will probably cut, especially the fact that unemployment is trending up right now, as we saw today. So if the Fed cuts 50 basis points, it just, again, it reaffirms my belief that the liquidity in the system is simply going to trend up for the next, at least for the next 6 to 12 months. And therefore, the prices of gold and silver is most likely going to trend up with it. Now, I'm going to share another chart with the audience. This one is also very good. It's charts of foreign central banks holdings of US Treasuries versus gold. So for the first time in the last 30 years, gold is now the number one global reserve asset of global foreign central banks, as opposed to US Treasury bonds.
That's momentous. It's a momentous change.
Yes.
Okay, so let's stay on the Fed here for a moment and the debt situation and also the global central banks. As the Fed needs to issue more and more treasury debt, there are many countries around the world who used to fund the US debt that are net sellers in favor of gold. That's clear by the chart you just showed. Then there are others who have their own debt problems, like over in Europe, and cannot fill the gap as they have to issue hundreds of billions of dollars of debt in hopes that others are going to buy it as well. We're entering a period now over the next 3 or so years where, Eric, about 70% of the total US debt pile, which is 8 trillion right now, it's maturing and it's not going to get paid back. Therefore, it needs to be reissued and rolled over. At the same time, to make matters worse, deficits are expanding from 2 trillion to possibly 2.5 to 3 trillion per year over the coming few years. And all of that is going to take place without a recession or major war. These numbers change if that happens. If the Fed has to fill the Treasury debt gap that will not be filled by all those other nations, what are the ramifications? And do you see that as the highest probability outcome, the Fed filling the gap?
Gary, I think what's going to happen is that the short term, the Fed has to cut interest rates and to reduce their debt burden. I mean, like to cut interest rates, I think that reduces the amount of dollars that they need to raise to service the debt. Okay? Because they borrow, like they have a $37 trillion in counting debt. And every 12 months they need to pay around $1 trillion and more, right? As their total debt pile gets higher, that interest rate get higher. So it's 1 trillion now, it might get to like 1.1 to 1.2 trillion every 12 months. So right now, let's just say 1 trillion. So if they cut interest rates, they are lowering the pressure of their debt servicing, right? Payments. So instead of 1 trillion or 1.1 trillion, if let's say they cut interest rates by 50 basis points, it might be 950 million. Okay? So that's part one. So I think cutting interest rates definitely help. Number one. Number two, they might have to do some form of QE. Okay? Which is the Fed has to start buying US Treasury bonds again in the next, I don't know, 12 months or 16 months. So that's the short-term remedy that I see, the Fed having to implement to help with the fiscal situation, with their debt situation.
Now, what's
Now,
the ramifications? Before you go on to the next part of that, what's the
yes.
ramifications of them lowering the interest rates and filling the gap by, buying some of these bonds?
Well, if they're doing that, I just fail to see how liquidity is going to contract globally or in the US because they're flooding the system with liquidity. Okay, so that's the short term. But like medium term, I think what's going to happen, Gary, and we have been discussing this, I think your other guest also mentioned this as well, is that the US is probably going to have to revalue the 8,133 metric tons of US Treasury physical gold.
So does the increased
Mark to
liquidity
market.
you were just talking about help
Yep,
help in that process by basically devaluing the US dollar versus gold, thereby having a higher gold price to be able to revalue?
it does. That's a very, very intelligent observation, Gary. So they do the Fed does this 1-2 punch, like I just explained. The liquidity level is high. Gold goes up to, let's say, 7,000 US dollars per troy ounce. They do the mark-to-market US Treasury gold revaluation. All of a sudden, voila, they got $5-6 trillion that the that the Federal Reserve can magically make appear at the TGA, which is the US Treasury General account. And that's free and clear, by the way. Okay, that's with like in exchange for the renewed gold certificates that the US Treasury is going to issue the Fed. I have a video explaining that. Okay, like how the revaluation process works. Okay, because in your program it's difficult to explain the whole process, but that's how it works basically. They revalue it, and then the Fed would give the US Treasury, whatever amounts of dollars that the two gold certificates, the old one and the new one, the differential represents, which is around $5-6 trillion. Let's just say. So with that $5-6 trillion, Gary, the U.S. government can kick the can down the road. They can resolve. They can depressurize the pressure cooker that is what it is right now, essentially.
Okay. Yeah. So there's some significant ramifications coming. There's obviously this is something that everybody needs to be keeping an eye on, paying attention to, understanding what's coming. There's this bubble of debt that needs to be rolled over. There's the rising deficits that need to be funded. Countries are not funding the U.S. debt the way they were, thereby putting pressure when all of these treasuries come through, and the Fed's going to have to fill the gap, and then that's going to create some inflation, which is going to devalue the dollar, rise gold, and then put them in the position that they want to be in to revalue if they so choose. So appreciate you explaining all of that. Let's move on here, Eric. China's yuan has dropped about 50% in value against gold over the last 2 years. If the yuan seems too weak versus the US dollar, it really means that the US dollar is too weak versus gold. This is something that Luke Roman has been talking about for quite some time. So to strengthen the yuan versus the dollar and curb China's export advantages, don't gold prices need to keep rising sharply like they have been? I mean, do you fully expect the US dollar to fall sharply in value versus gold over the next few years to bring the Chinese yuan versus the US dollar correlation back into balance?
I do. Like Luke actually made an observation. He said that if the US dollar value of physical gold is at $20,000 right now, there won't be a US trade deficit with China, because the amounts of gold that China imports into the US represent the deficit that the US has with China right now. So it's actually rather brilliant. But like I explained before, it will take some time, and it will probably take 1 or 2 physical gold revaluation at the US Treasury. So let's see what happens.
Yeah. Okay. Well,
Yep.
this has been an incredible discussion. I just want to welcome everyone who's tuning into this fantastic interview with Eric Yeung, precious metals analyst and investment expert. Before we wrap up with our final set of questions for Eric, I want to direct everyone interested into the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join our quickly growing community, receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio. That's the name of the report. Now, I'm positive you've been enjoying the conversation that Eric and I have been having. Please let him know, hit the like and subscribe button, and leave a comment below the video. Eric, before we started recording, we talked about a lightning round. We did this the last time you were on the show. Let's move into this. I'm going to ask you to rank a few assets as a buy or a sell by giving it a score of 1 to 100. 100 being an extreme buy, 1 being an extreme sell. Then just give 1 sentence, maybe 2, as to why you take that position. If it's an asset you're not following, that's okay, but let's try to roll through this as quickly as we can. Okay. So right now, on a scale of 1 to 100, is gold a buy or a sell, and why?
I think it's 90, because I think the global need for physical gold is actually just in this second inning, maybe beginning of the second inning.
Okay. Gold
That's
miners.
yeah.
Gold miners, 1 to 100.
Gold miners, probably I would say 90 again, because I think a lot of the good quality gold miners are still in the process of just waking up. How do I know? Because I own some of them. That's
Right.
it. That's it. Yeah.
One to
Yeah.
100 is physical silver a buy or a sell.
Definitely a buy. Definitely a buy. I will give it 90 again. Simply because, again, I own a lot of them, and a whole bunch of them are just beginning to wake up. So we're really early stage right now
Okay, so
for
that's the
silver miners.
that's silver miners. What about physical silver?
Same thing, Gary. 90. Because I mean, like, we're at $40 right now. I see silver. I tell people, even $100 silver is cheap,
Yeah.
in my opinion. So 40, it's just the
Okay.
beginning.
All right.
Yeah.
Copper.
Copper, I think I would give it 70, just because we don't know how deep the stagflation is going to run in the
Okay.
next 24 months.
Yeah. All right. Uranium, the metal.
I actually like uranium. I own a lot of uranium. miners and also ETF. And I would give it an 8 simply because, again, because of the stagflation, I don't know how high or low oil is going to be.
Is that an 80?
So
Did you say 80?
80, 80,
Okay.
correct, for uranium. Yep.
Okay. Now, is that the miners or is that the physical metal?
Both, for
Okay.
both. Yeah.
All right.
Yeah.
I heard you mention oil. Let's go to oil.
Oil, I give it a 60, simply because it's so geopolitically connected, and the fact that the US is such a big oil producer. Even though I know that Luke and a bunch of other people have told me that the peak oil in the US already happened with the shale oil technology, right? So they
I'm sorry?
already shale oil, the shale
Yeah.
oil, like yes. Hello?
Yeah, I can hear
Yeah,
you.
the shell oil in the US, like not the traditional, kind of oil wells in Saudi Arabia, like the kind of oil that they got to blast, the solid shell to get the oil. I've been told that that already peaked, like the easy ones. So now it's a lot more difficult to have access to. But even then, the US have a lot of oil, and therefore I think they probably have a higher control of the oil price than the other commodities that we're looking at. So
Okay.
therefore, six out of 10.
All right.
Yeah.
The NASDAQ.
Nasdaq, I give it 5, simply because
Five out
it's
of 100 or 50?
5, no, so 50, 50. Sorry,
Okay.
50. So uranium 80. So uranium is I said 80, right?
Yes.
Copper 70. And then the oil, I said 60. And with Nasdaq, I'm saying 50.
Okay.
Okay. The reason is because we're in bubble territory. That thing can pop or deflate anytime. That's it.
Okay. What
Yep.
about the S&P 500? Do you look at it differently or the same?
Same thing. Same as
Okay.
the Nasdaq. Yep.
All right. Short-term treasuries.
Oh, okay. Probably 70, just because like I look at short-term treasuries as just cash with a yield attached to it. That's it. So
Okay.
that's why, you see a lot of foreign countries when they rotate out of long-term treasuries, a lot of the times they park some of that in short term. So
Yeah.
therefore, in my opinion, 70 out of 100.
Okay.
Like if you
Long.
talk about volatility wise though, right? If you talk about like investment gains, of course it's a lot lower than 70. But
Yeah.
like,
No, but because of
yeah,
the
yeah.
optionality it gives you.
Okay, yeah.
Yeah.
But you can cash out, right? So 70. Yeah.
Okay. Long-term treasuries.
Oh, well, that's like a 30, my friend, or
Okay.
less. Just because, like, who the heck wants to hold US Treasury bonds for 10 years plus when they're only paying you under 5%, slightly under 5? It's ridiculous.
Yeah.
Forget it. I should
Okay.
give it negative if I can, right? But like,
Okay.
let's be generous, 20 to 30, something
Okay.
like that. Yeah.
On a scale of 1 to 10, each representing a percentage, where do you see inflation ending the year?
I think we're going to get close to 3%, simply because Federal Reserve already made a statement saying that 2% is no longer something that they're aiming towards. It's going to be higher than 2%. So,
All right.
yeah.
1 to 10 probability we're headed into a recession by the end of 2025, 10 being the highest.
Uh, I think we're already in the recession. So 10.
Okay. And
Yeah.
finally, the recommended portfolio allocation by financial advisors has been 60-40, 60% stocks, 40% bonds, but they don't ever, say you should own precious metals or precious metals equities. Um, no advisors recommend that. Well, in this new paradigm, what percentage do you recommend or do you think folks should own precious metals related equities, and which buckets are you pulling from? The 60, the 40?
I would say like 15% physical gold, probably around 5 to 10% physical silver, and then maybe something like 20% to 25% gold, silver, and uranium mining stocks, and the rest just keep it in cash.
So you're
Like
50.
some sort of like short-term treasury, what we talked about, the seven, right? Like T-bills.
Yeah, so you're 50
Surprising,
to
isn't it? Yeah,
50,
sorry, go ahead.
you're
Yeah,
50 to 60% gold and precious metals and precious metals related equities, and
correct.
the rest cash for optionality.
Yield generating cash.
Yeah,
Okay. So like CDs or like you know short-term treasury T-bills.
got it. Well,
Yep.
Eric, you've been so generous with your time, analysis, and ideas. Thanks for being on. Would you share a key takeaway that you want viewers to keep in mind about today's economic market, monetary situation? Anything you want to share? And then let everybody know how they can connect with you.
Okay, so I think like again, like like what I said in the beginning of the program, it's not too late to get into physical gold and silver. So I would tell everybody to just watch for dips and then dollar cost average your purchases of physical gold and silver. I think that should be the foundation of anyone's portfolio if they're interested in this space. And then once you have the physical gold and silver going, you might want to look at the gold, silver, and uranium miners. So that's my advice to people. And people can find me on X at King Kong 9888.
Wonderful. Obviously, that's up on the screen now. It'll be on the screen throughout our discussion here. Eric, always my friend, look forward to having you on, and I'll have you back sometime soon. Thanks for being here. Thanks for sharing. Everybody else, thanks for watching.
Thank you, Gary.
Before we wrap up with our final set of questions for Eric, I want to direct everyone interested into the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join our quickly growing community, receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio. That's the name of the report.